In our ideas for profit today, we'll discuss about Vidhi Specialty food ingredients, which has had a strong transformation in the operational performance in the last few years. Also, earlier the company had a high share of revenue from its trading business. Now, its business largely depends on the manufacturing of colors of foods and of personal care as well. Now, further, it is consistently adding the high margin products to its portfolio as well. Now, let's focus on all the parameters to find out if investors should keep this stock on their radar. Well, the Q1 performance was a blip, though a strong improvement in margins was definitely recorded in Q1. The sales declined by 22% year on year, and that was on account of the production suspensions warranted by the lockdown due to COVID-19 and also the disruptions caused by the Nisagra cyclone. Export sales were also adversely affected by the limited functioning of the JNPT port. Also, having said that, due to the lower raw material costs and the higher reliance on the manufactured goods, you see the gross margins expanded by say 268 basis points year on year. EBITDA margins expanded also by 122 basis points, partially weighed by the operating deleverage as well. Now, the company has been consistently following the strategy of lowering the reliance of the traded sales and replacing it with the sales through the own manufacturing goods. Additionally, it has also pursued to debottleneck a lot of initiatives which has increased the production efficiency to about 300 tons per month. In parallel, the sales of the manufactured goods also has jumped by 80% in the last 4 years, which definitely point towards the enhanced product mix that the company has. Impact of these changes can be seen for the operating margin, which is up 700 basis points in the last 4 years. In the recently held AGM, the management also updated that the company is undergoing Capex worth 90 crore rupees, which will increase the capacity from the present 3,600 tons to about 9,000 tons per annum. Now, at the peak capacity utilization, these investments should definitely help the company clock in about 700 crore rupees of a turnover. Now, the company's net debt as of 31st of March 2020 is lower by 27% compared to the level that was seen in FY19. Its net debt to equity ratio is at 0.14x and is down from 0.26x in FY18. Now, while all of these provide scope to raise funds for expansion, the management is quite hopeful that the internal accruals should definitely take care of the large part of the Capex funding. Now, the company is also investing behind the backward integration as well. And so far, the two key raw materials are now captively produced, and the company also plans to add 2 more ingredients for the in-house manufacturing alone. Now, this is important because the company quite relies on China for about 55% of the raw material requirements currently. Now, in the near term, an improvement in the product mix, the lower share of trading business and also the backward integration together are expected to improve the earnings also going forward. Now, operating margins should definitely remain north of say 20%. However, the margin expansion beyond 24% would be contingent on the Capex plans and wherein the company really plans to manufacture more value added products. Now, execution risk for the major Capex remains a definite watch out for the coming quarters. And coming to valuations, after the recent run up that we've seen in the stock is quite optically quite expensive. The EV to EBITDA of 9.9x for FY22 estimated earnings is quite high. However, we acknowledge the true potential of the company will express only after the expansion, and it will take about 3 to 5 years to witness the same. And hence, the investors with high risk appetite can definitely consider this opportunity.